Will the U.S. stock market rise tomorrow, or is another crash imminent? That is the question currently paralyzing investors. Recent, nerve-wracking volatility has left traders frozen in uncertainty, unable to determine if the next move is up or down. The S&P 500, Nasdaq, and Dow Jones serve as the collective, measurable pulse of the U.S. economy, tracking this instability in real time. These major indices are broadcasting violently mixed signals, alternating between sudden, sharp recoveries and equally aggressive drops. Predicting tomorrow's outcome requires isolating the two massive, opposing economic forces currently fighting for control of the market. The technology sector acts as the foundational pillar of current growth. Due to sector weighting, these companies exert an outsized influence on the entire market. Quantitative data from the last quarter shows massive recovery within major tech stocks, even as traditional sectors like manufacturing and utilities begin to stagnate. Zooming into that data reveals that artificial intelligence companies are the primary catalyst driving this entire tech resurgence. Mechanically, the explosive gains of these AI firms create concentrated positive momentum, pulling up the averages of broader indices like the S&P 500. This structure carries a specific risk. Market health is currently concentrated in one specialized industry rather than reflecting broad economic strength. Without this isolated boom in AI, the broader market indices would likely be enduring a severe and sustained downturn. Acting as gravity against this climb are the broader macroeconomic headwinds currently suppressing the recovery. High sustained interest rates create a heavy burden, as the rising cost of borrowing makes it difficult for businesses to expand. This chart tracks inflation against spending. As inflation remains above target levels, it suppresses consumer purchasing power and reduces discretionary spending across the country. The looming threat of unexpected news, like geopolitical shifts or sudden policy changes, acts as a risk multiplier for these existing financial pressures. The combination of inflation and rate fears creates a psychological barrier, causing institutional investors to hesitate before committing capital. These macroeconomic factors create a persistent ceiling, fighting the tech boom and dragging the overall market back toward a crash. We are watching a direct collision. Unprecedented technological growth is smashing into the ceiling of stubborn economic reality. This friction is the source of the volatility investors experience daily. Most financial analysts are now looking at which side of this stalemate holds the most long-term leverage. The underlying strength of the AI recovery leads many analysts to believe the market maintains a slightly bullish edge for the immediate future. However, a slightly bullish prediction offers little stability. Further violent swings are expected as long as interest rates remain high. The market's mid-term direction depends entirely on which of these two competing forces eventually breaks first. Weighing the AI boom against these inflation fears, what is your prediction for tomorrow? Bull market or bear market? Comment below.